We're going to use the MixMax company case again this semester to help us get a better and clearer understanding of some transactions. So we're going to start with June MixMax. I've got some extra assignments created in it. Instead of using your textbook, we'll use the MixMax case. So if you will, just flip through, it's actually several other pages, until you get to June MixMax. And then as you go through the balance sheet and income statement, this is what I want us to look at today, this depreciation schedule. Now we're going to do this somewhat manually in this lecture. Notice that you're going to set these up. Actually, when you go to yours, you're going to see it says 5 depreciation schedules. So you're going to set these up using Excel. So you want to make sure as I go through that you really understand how to do the calculation so that you can put it in Excel. Well, first off, let's talk about what depreciation is. It's really taking cost of an asset and allocating it over time, right? We allocate that cost while we're using that long-term asset. But it needs to be a systematic and rational method. So we're just systematically and or rationally allocating the cost of the asset to the periods benefited. And you can see that particular definition in your textbook. Now for MixMax, if you go back, you'll see they've had $45,000 of equipment. We've seen that all along in this case. So go back, we can see June 1, $45,000. However, on June 30, we can see they must have sold some of the equipment, right? Because it's gone down to $27,000. But so we're just going to do a what if. So if they kept all this equipment, the truck, the wagon, and the auto at $45,000 with the salvage, the salvage value is their estimate of what they think they can sell these assets for at the end of their useful life. So at the end of 3 years, they think they can sell the truck for $1,800, the wagon for $1,440, and the auto for $1,260. Also, the case gives you market value. Now you have to think, what does market value have to do with depreciation? Well, the answer to that would be it doesn't. That's irrelevant information that's not useful in calculating this depreciation. So if you flip through your pages, you're going to see I've got 2 schedules for depreciation here, and there's 3 on the next page. The first method, the straight line, you've seen before. The straight line just takes cost, right, of $45,000, right, and we subtract the salvage of $4,500, and that gives us $40,500, and that's the amount to be depreciated. So I'm just going to abbreviate that amount to be depreciated. So in all of these cases, at least the ones used for the income statement, the total depreciation expense over these assets' 5-year life should be $40,500. Now for the straight line method, it's pretty easy, isn't it? We just take that $40,500 and divide by 5 years, and you're going to get $8,100. Okay, so why don't you pause the video and fill this out? I'll do the first line and then you can fill it out. But the annual amount is $8,100. If we wanted to get the monthly amount, just divide that by 12. You should see a number that looks familiar, $675. If you remember those first 5 assignments in MixMax, the monthly depreciation was always $675. Cost, right? Cost is going to say in those asset accounts. So we have property, plant, and equipment with a cost of $45,000. At the end of the first year, right, when we record depreciation expense, we debit the expense, credit accumulated depreciation, that'll grow to $8,100. Book value is the net of that. So cost minus accumulated depreciation equals our book value. So on the balance sheet, we'll show the assets, $45,000. We'll subtract accumulated depreciation, and that will give us a book value of $36,900. And those 3 numbers, these 3 numbers will go on the balance sheet. Okay, so why don't you go ahead, just fill out the rest of this, and I'll pause. Okay, so your depreciation schedule should look like this: $8,100 a year, accumulated grows by $8,100 each year. And so what I want to point out is, notice at the end, accumulated depreciation equals the amount to be depreciated, and book value should also agree to the salvage value, or residual value, whatever you want to call it, but the amount they anticipate they can sell these assets for at the end of their useful life. Okay, so they're a straight line. The next method is called sum of the year's digits method, and it's actually kind of easy in a way, but not as easy as straight line. But the name tells us what we're going to do. We're going to sum the digits of the years. So 1 year plus 2 years plus 3 years plus 4 years plus 5 years. Oops, didn't get my plus sign. Is 15, and that's going to be our denominator for all the years. We can shortcut that. There is a formula. Just take n times n plus 1 and divide by 2. So if I plug that in, we would have 5 years times 5 plus 1, and we divide that by 2. So 5 times 6 is 30. Divide by 2, we would also get 15. So there is a formula for that to arrive at that. So what's going to happen is that it'll be the sum of the year's digits, but in reverse order. So what we're going to see here, just kind of give you a little bit of a picture. Straight line depreciation, we had the same amount of depreciation year after year, right? $8,100, and that's straight line. It's flat. So, you know, if this represents time, if that represents time, and this is our depreciation expense, we had $8,100 each year. Now, there's other methods that will start with higher depreciation expense early on in the asset's year, and then that'll shrink. And those will look more like this. Those are called accelerated methods. Accelerated depreciation methods. So we have the straight line and we have accelerated methods. Now the theory is, if I use an accelerated method, it's because I'm supporting the idea that these vehicles, I'm going to get more use out of them early on in the asset's life. So I should depreciate or use up more of the cost early on in the asset's life, and as the asset gets older and older, I really don't get as much benefit from it, so it should have smaller amounts of depreciation. Again, look at what we're trying to do with depreciation. Allocate cost to the periods benefited. So the idea with the accelerated is we're getting more benefit early on in the asset's life and less benefit later on. With sum of the year's digits, what we're going to do is we'll have a denominator of 15, and then we're just going to put, so for year 1 it'll be 4/15, for year 2 it'll be 4/15, for year 3 it'll be 3/15, and year 4 2/15, and then the last year 1/15. So you can see we're just going in reverse order. 5, 4, 3, 2, 1, and every time we're dividing by 15. Okay, paused it because I had a train going by. We're back in. I went ahead and changed this, you probably noticed, so it kind of aligns. So 5/15, 4/15, 3/15, 2, 1. Those are going to total 15 out of 15, won't it? Or 100%. So 100% there. Okay, and so what you do with the sum of the year's digits is that I just take 5/15 times this amount to be depreciated. So 40,500 times 5/15, you're going to get 13,500. The second year, I would take 4/15 times this 40,500, and I'll get 10,800. The third year, 3/15 times my 40,500, $8,100. Second year, 2/15 times 40,500, 5,400. And then lastly, 1/15 times 40,500, I'll get 2,700. Add those up, and those will total exactly 40,500, is exactly what we wanted to happen. Okay, so then just fill this out, divide by 12 to get this. Your accumulated depreciation the first year is going to be 13,500, right? We debit depreciation expense, credit accumulated to get that amount. But the second year, we'll be crediting accumulated depreciation for this expense, debiting the expense, so this is going to grow. So I'm going to pause while you fill all of this out. Okay, you can check your answers. Again, notice accumulated depreciation, you should end up with this 40,500, and then book value will equal the 4,500 salvage value. Now, just a note before we go any further, when you're going to create these depreciation schedules, and feel free, just have straight line, and then right below it have some of year's digits. There's no need having a sheet, an Excel sheet for each of these. Just put them all on one big sheet. It should look just like what I have on these headings and over here on the side. I suggest that you complete the straight line method and then just copy and paste down to the next. And then, you're going to need to change the formulas for your expense. But, if you've programmed your formulas, for cost and accumulated depreciation and then book value equals cost minus that, it's going to be, these will be the same formulas here as they will be down here. So again, I suggest do the straight line first and then just copy and paste and then edit as you go through the remaining depreciation schedules. The other thing is you should have a data input area on your Excel spreadsheet. And so really the data input, you should have a data input for cost, and you should have a data input for salvage. Whoop. And of course then you want to calculate the amount to be depreciated. So your data input, you need to have a data input for cost, salvage. You can calculate that 40,500. Just put those three numbers somewhere at the top, and then have straight line, sum of year's digits, etc., etc. Okay? All right, we have looked at one accelerated method, that is sum of the year's digits, and we can see there's higher depreciation early on, and then it shrinks down. So it certainly does look like this little diagram we put together. So now let's look at double declining balance. Double declining balance is a little bit more complicated. It does not use the base of 40,500. Instead, it's going to use the base is going to be book value. Okay. So it's going to be using book value. So instead of taking, some rate times 40,500, it's going to have a rate times book value. Now that rate is, so we're going to use book value, and so double declining balance, here's its formula. We're going to take that beginning of the year book value, beginning of the year book value, times double the straight line rate. So we will double the straight line rate. So we take the beginning of the year book value times double the straight line rate. So for year one, what's its book value? Well, on January 1, we would have cost. Now, there is no depreciation yet at the end of the first, at the beginning of the first year, right? We have no depreciation. So book value at the beginning is $45,000. So for year one, beginning book value is just going to be cost $45,000. There's no accumulated depreciation at the beginning. Doubling the straight line rate, well, if you think about it, we have 5 years. 1, 2, 3, 4, 5. Well, what's the straight line rate? Well, in year one, it's 1/5. Year two, 1/5. Year three, 1/5. Year four, 1/5. Year five, 1/5. If I were to hold up my fingers, show you my hand, 1/5, 1/5, 1/5, 1/5, 1/5. If these were my 5 fingers, I would just be pointing out each finger is 1/5 of my hand, right? So if we have 5 years, the straight line annual rate is 1/5. So we're going to double that to 2/5. So in this particular problem, the straight line rate is 1/5, and we'll double it to 2/5. And we're going to take that 2/5, or 40%, times beginning book value. So for the first year then, we're going to take 45,000 times 40%, and you should get $18,000. Then at the end of the year, right, at December 31st, we debit depreciation expense, credit accumulated depreciation. This will grow to 18. And then book value, which equals cost minus accumulated depreciation, will be 27,000. Okay, then the second year. beginning, last year's ending is this year's beginning, so we'll take 27,000, that's our beginning book value, times 40%, and you'll get 10,800. And then we book debit depreciation expense, credit accumulated. That will increase our accumulated depreciation to 28,800. Okay, I'm going to pause and let you finish all of this out. Okay, now assuming you have filled this out, I didn't do the monthly expense. All you're doing, like we did before, is divide that annual by 12 to get the monthly, and you can do that. I do want to point out we have some problems here with the double declining balance method. Because the base is book value, then it just kind of keeps going on. And look, we have book value is less than our $4,500 salvage value, and we have depreciated above our $40,500. We have, so we've over depreciated these assets using the double declining balance. So here's what we have to do. Essentially these numbers just aren't behaving the way we want them to. So I always like to joke, well, as an accountant, sometimes you just have to slap your numbers around and make them work the way you need for them to work. So we can see here in this last year, we can see that we did have 5832 here. I'll use a little bit darker number here, but we had 5,832 going in before we recorded our last year. So we had not gone below salvage value of 4,500. We have 5832 there. And so what we're going to do is just, make it work. We know the last year then we need for this to be $4,500. And so if that's 4,500, then let's back into some numbers. If that's 4,500 and that equals 45,000 minus accumulated, then accumulated has to be 40,500. So we need it to be that number. Well, how do I get that to be 40,500? Well, accumulated before was this 39,168, and now it's 40,500. And the difference then, and I'm just going to scratch this out, year 5, 39,168 plus what equals 40,500. This number has got to be 1,332. I just make it work. So if we have this balance, I add in the current depreciation, that credit to accumulated depreciation, it'll give me a balance of 40,500. And by the way, now if I add these 5 numbers, I'm going to get it to equal 40,500, and we're in good shape. And I'm going to show you in a little bit how to put that in Excel and make your Excel spreadsheet work for you without having to go in and do this individually. Okay, as a matter of fact, let's just stop and go over and do that. Okay, so here we are in Excel, and I've left it with the mistake, the 2,333, and again, we've over depreciated the asset, and we've got book value below salvage value, so we have a problem. So I'm going to show you, we're going to start, I'm going to actually just delete formulas I used there, and let's go back. I'll just get rid of that. Let's go back for the annual expense. So we know the first year we're taking cost times our 40%. Now the second year we have to give it a, figure it out. And by the way, I'm going to go ahead and start in year 2, even though for this particular problem, it's not a concern. We know that there's no problems with the double declining balance till we get to the 5th year. But I'm just going to go ahead and put this formula in year 2, and we'll copy it down. Because, if I had a 30-year asset, it's hard to know when is double declining balance going to start having problems and depreciating too much. So we're going to go ahead here. So here's the thing. I'm going to do equal if. So, equal if. So we've got the if function here, and we're going to give it a logic command. You can see right here, we're going to do a logic test, and we're going to give it a certain value, and then if this value is true, we'll tell you it to do something, and if that value is false, we'll have it do something else. So really, what we want to do here is we want to look at at the end of the second year, what would accumulated depreciation be? And we want to compare that with the amount to be depreciated. So, matter of fact, you know what, I don't have it on here. I'm going to go ahead and just, actually I need to get out of this. Let's show our cost of $45,000 and then salvage of $4,500, and then I'm going to get the amount to be depreciated to be $40,500, and I'm going to use that here in my formula. So what I want to do is, here's the amount to be depreciated. That should never, accumulated, and I want to compare that with accumulated depreciation. At the end of the period. Oh, well, that may give me, what's this? Okay, there we go. Alright, so we're going to compare what the accumulated depreciation would be at the end of the period, and that should never go above $40,500, right? If it goes above that, we've made a mistake. So what we're going to do when I do the if function, so equals if, and then I'm going to put a parentheses because I'm going to start doing my comparison. And so I want to compare, here we had this beginning accumulated depreciation, and then I'm going to add to that what year two's depreciation would be. Well, year two's depreciation is really taking, right, beginning book value times 40%. I need to go in and put some parentheses in. Okay, so if you look up here, I have if, and I have beginning accumulated depreciation, the $18,000, and I have added to that this year's depreciation expense, which was $27,000, this G44 times 4%. So that formula right there is giving me what our accumulated depreciation would be. I need to do that. Okay, now if that is greater than, if that is greater than the amount to be depreciated. So I'm going to put in that formula. Now, if by the way, you're going to have this up higher on your spreadsheet, but I need to put in, since I'm going to copy this, let's put the dollar sign instead in front of the N and in front of the 44, because remember that keeps it fixed, because if I don't fix it on that cell, when I copy it, then it's going to copy down to that cell, and that cell. So we don't want this moving, so I put dollar sign N, dollar sign 44. Okay, then a comma. Oop. After the 44, a comma. Okay, so we've got if accumulated depreciation, and I do beginning accumulated depreciation plus depreciation expense for year two, is greater than the amount to be depreciated. Now, if that is true, we have a problem. And if we do have a problem, we want to just then compare our book value with the residual value, right? We don't, so we're just going to say, then that's going to equal our book value which is 27,000. So G44 minus our residual value in 43. And again, in this case, it doesn't apply. And then in 43, I want to put a dollar sign in, dollar sign 43. So again, I am just comparing book value with salvage value. And remember, I mean, you know, in year 5, this was down to like $3,000. So $3,000, you know, versus $4,500, then that would give us the, you know, the right number. Okay, anyhow, going on. So this is what we're going to do if it's true. put a comma, and then if it's false, then we're just going to have our regular depreciation expense. And so the regular depreciation expense again would just be this book value times 40%. And then at the end of that, I put parentheses enclosed. So I start with parentheses, I end with parentheses, and I just have a little thing here in parentheses in the middle. Okay, let's see. Oh, you know what? Let's see if that'll work. I may have made a mistake. Let's hold off. We'll see if it works. 10,800. I'm going to copy it all the way down. Yep, it worked for me. So notice I got my 40,500. In the last year, let's look at what happened. It compared. It took K47, so let's go to K47. It took this accumulated depreciation at the end, and it added the normal depreciation expense for year 5. And if you recall, that had been $23.33. It had been something like $2,332. So, in other words, we've got a book value which is greater than. So we have if the excuse me, I said book value. I said that wrong. If the accumulated depreciation, and remember it totaled like 41,000 at the end of the 5th year when we first did this. So we had like 41,000 here. So we took beginning plus this year's depreciation expense to get the ending. And previously that had been something like 41. I forget what it was, but it was a lot. But anyhow, so we're comparing what accumulated depreciation would be. We compare that with the amount to be depreciated, this 40,500, and we found out that it was greater than that. So accumulated depreciation exceeded that. It shouldn't, and so that is true. So then what we want to happen then is that we're just going to take, in this case it was G47, so we took this G47 and we subtracted N43. And so N43 was our 4,500. So let me say that one more time. So here, this right here is what happened. It was true, and here's what it did. It took G47, right, book value at the end of last year, and we subtracted the salvage value, right, because here's what it is, here's what we want it to be. We can see that already in this Excel spreadsheet. So the difference between these two needs to be what's in our annual expense this year, $1,332. So anyhow, that'll work for you. Okay, now I've switched back over to where we were doing it manually. If you will, turn your page once. I'm going to go stop for just a minute and I'll be right back. Okay, so I've got my page looking in the same direction as yours now. What I've done, and so I want us to look at the really big picture of what difference does it make if we use straight line method or double declining balance. So, or an accelerated method. And so I'm just demonstrating an accelerated method. I chose to use the double declining balance method. I just, instead of sum of years digits, I chose double declining balance. Okay, if you go over one page, I've kind of have scheduled out depreciation expense. Now depreciation expense, if we had used straight line, was $8,100 each year. So if we were to draw that out, it would look something like this. And I hope you'll be able to draw better than I can, but again, that's the straight line. Now for the double declining balance in year 1, it was way up here at 18,000, and then year 2, something like 10,800. And then year 3, 6480 here, and then 3,881 year 4, and year 5, 1332. And again, I'm just pulling those off our depreciation schedule. And by the way, I've here's depreciation expense. So there's the 18, 10, 8, 64, 80, 38, 88, 13, 32, and listed those over here. So I guess this is 38, 88. Anyhow, just kind of try to get my line in somehow there. Not working the best, but anyhow, we're going to see here's straight line and here's an accelerated. And eventually, you know, even though we start with more depreciation expense under the accelerated method, eventually it will turn itself around in this area. So it's going to turn around. Get that right very well. Okay, so keeping that in mind, let's go back to our schedule then. So, all I've done is from your depreciation schedules, I copied over the book value and for straight line and book value. So notice at the end, we always get the same amount, $4,500, because that was our goal. We would depreciate it down to salvage value. Now I just pulled that number out of the air. I said, how about let's make income before depreciation and tax expense $25,000 for all 5 years. Then I listed depreciation expense if it had been straight line, and depreciation expense if it had been double declining balance. Well, of course, that's going to change then, income before taxes. And since income before taxes is different, income tax expense will be different because it's based on that number. So what we're going to see is that these numbers during the 5 years will be different, but in totals, they're all the same. In total, it's all going to be the same. So the bottom line is, in the long run, we're not going to see any difference, but it's in the intermediary, you know, during the asset's life, we're going to see some differences. So here's the thing. Companies can use one method for financial statement purposes, and the tax law allows us to use a different method for tax purposes. So on our tax return, we can use an accelerated method, and for financial statement purposes, a straight line. Now, I will say, just make a point while we're here, current tax law does not allow double declining balance method to be used. It has, Congress has created their own accelerated method, and it's not as easy to compare it with straight line. So I'm just chose for illustration purposes, given the tax law uses an accelerated method, we're going to use double declining balance because the numbers are going to be easier for you to see what's going on. Next class period, we will look at using the methods used for tax law, and again, they aren't quite as straightforward. So anyhow, we're just comparing the straight line method with an accelerated method. Use straight line for financial statement purposes. Let's use an accelerated method for the tax return. So if we do that, then on our tax return, we figure out, you know, how much money do we have to pay the IRS? Well, right, that's our credit to cash, or that's our credit to taxes payable. On our income statement, what we're solving for is income tax expense. There's our debit. So here we're debiting income tax expense, but here's the actual cash we're paying out. So on the next page, I've taken our actual expense and scheduled out our actual cash payments so we can compare those two. So here's our income tax expense based on straight line. Here's the taxes paid based on an accelerated method. And we can see, particularly in the first 2 years, there's cash savings. You know, and $3,000, $1,000 may not sound like a lot. Well, they might for us personally. For a big corporation, it wouldn't be. But make that $3 million or $1 million, and you'll start to see why companies will hire accountants to use these, you know, do one depreciation method for the income statement and a different method for tax returns. And by the way, it's all on the up and up. It's interesting under, you know, when we did inventory, because we had inventory cost allocation methods, right? In LIFO versus FIFO. So LIFO versus FIFO. Now, what's kind of interesting about that is that if I use LIFO for tax purposes, I have to use it for financial statement purposes. So we don't usually see companies really using different inventory cost flow methods for accounting purposes versus tax return purposes. But it is very common when it comes to depreciation. Okay, so we have, in essence, two different, not full set of accounting records, but two separate records for depreciation. One for our tax return, one for our tax return, one for our income statement. Okay, so we get these different amounts for taxes. So we can see there's tax savings, but then when we get down to these years, right, these depreciation years, when it turns around, we get a turnaround. So let's look at the first year. Here we have the accelerated depreciation expense. If we have a large expense, right, it will lower our income. Lower income means lower income taxes paid. Let's go to the third year, though. Here's our third year. We had smaller depreciation expense. Smaller expense leads to higher income. Higher income means higher income taxes paid. So then we have this turnaround taking place. Okay, so let's look at then, if the accountant has this amount for the expense, and this is the cash payment, well, or the payable, then how do we record these? Well, here's going to be our income tax entry now. So here's our expense, year one, $6,760. Here's how much cash we paid, or put it in the payable, and within the year, really within a few weeks, we'll pay that out. So income tax payable or the cash account. And then we're going to plug the difference, that $39.60, to a new liability account, deferred tax liability. And let's post that $39.60 there. So at the end of year one, we have a liability. So the cash savings is really something we're going to owe before we're finished with this asset. Let's go to the second year. Same thing. We have an income tax expense of $67.60, but we're only paying out $56.80 that year. So we have cash savings, which is really creates this liability of $1,080. So I post that to my deferred tax liability account, and now I have a balance of $5,040 at the end of year two. Now let's go to year three, where it turns around. In year three, we still have the expense, $67.60, but we're going to pay cash, or owe cash in the short run, of $7,408. Well, now I need a debit to balance. So I'm going to debit that liability account, $648. So let's go post our debit, $648. And now I have a remaining balance, $4,392 at the end of the third year. And then you just keep doing that. So let's go ahead and finish this out. Post our debit is $1685. And now we have a balance of $2,707 at the end of year four. Last year, and by the way, you may have already noticed, that's interesting, this liability has the exact same balance as this cash savings, and it will work out that smoothly. It should. It's intended to. So we have our expense, record our payable, which eventually soon will become a cash payment, and then plug our debit, $2707, to balance. Let's post that down here, and we zero out at the end of the fifth year. So we can see, really, this interesting concept of using straight line versus an accelerated method really becomes a liability to the IRS. And it's actually, you can think of it as a great tool. It's an interest-free loan from the government. Right? In essence, the first year, it's like we borrowed $39.60, and then another $1,080, and then we just kept paying it off. But it's not a formal loan by any means, but it is a system Congress set up by using an accelerated method for tax purposes to give cash savings in the short run, but then in the long run, the corporation comes back and pays back those cash savings, or that loan, if you will. Okay, so we're going to see this now in MixMax. So let's go to the next page. And by the way, here I've showed you how From here on out, we're going to see MixMax is going to have a deferred tax liability of $198. And that's because they're getting rid of one of their automobiles. So instead of $675, the monthly depreciation is going to be $405. If they had used double declining balance, it would have been $900 if you want to go back and do the calculation. They have a 40% tax rate. So there's that. But I just want to show you when you do the T accounts for June MixMax. There will be there now is going to be a deferred tax liability account. And in the month of June, that account went up $198. So when you make your journal entry for income tax expense, you'll get the dollar amount for income tax expense off the income statement. By the way, for June, it happens to be $4,000. What we've been doing is crediting that to income tax payable. However, now we're going to see not only that's a related account, but there's also another related account to income tax expense, and that's this deferred tax liability account. So since we know this is 198, I'm going to just go ahead and plug that there, or put that there, and then you will plug to make this balance 3802 to your income tax payable. So when you're doing June, there will be that. Okay, I have come back to the depreciation schedules. There's two MACRS schedules that I want you to fill out. So MACRS can have different life of assets, and the tax law very clearly defines what those are. And usually the life of the asset is much smaller than what you and I or most accountants would estimate the useful life. So it's not exactly a useful life, it's just a life assigned for tax purposes. So again, the thing about MACRS is that it's a very fast, very fast accelerated method. Sorry, I was trying to look for my, so where I did straight line and here's accelerated, MACRS is very accelerated. It would be something like this. So over time, where a normal accelerated method would stretch out to here, MACRS gives it a shorter life, and so it's very fast. Because it's so very fast, MACRS is not allowed for financial statement purposes. The FASB disallows MACRS for generally accepted accounting principles. It's not allowed. So a company does not have the option of using MACRS on the income statement. Now, you'll determine what's a 5-year or 3-year asset by tax law, and then it's just kind of real easy. It's kind of interesting. We do not pay attention to the amount to be depreciated. We're going to depreciate the full cost. So for these assets, remember their cost is $45,000. We're going to depreciate a full $45,000. So before we only depreciated $40,500, we get to depreciate the whole cost for tax purposes. Now we wouldn't want to for the income statement because we'd rather have less expense reported on the income statement to have higher profits. But for tax purposes, we want income to be low, so we have small or low income taxes that we pay. So, so anyhow, we're just going to take cost times the rate, and that will give us our depreciation expense that we get to deduct for tax purposes. So we're going to start with $45,000, and we'll take it times the rate. So I want you to go, we're going to turn to, I think page 615 of your textbooks will show the rates. So let's look at those. I hope you've turned to your book. So here we can actually see, here we have rates. This doesn't show very well on mine, so if you will, turn to your book. But for the 3-year, here are different rates, and of course those are going to total 100%. And then for the 5-year as well, those will total 100%. So notice in the 5-year, the first year is 20%, the second year is 32%. So what we're going to do is we will take our $45,000 for the first year and take it times that 20%. And that will give us, I think that's $9,000 for year 1. And then for year 2, we take the $45,000, and the rate is now 32%, and we get $14,400. Now, what's going on, you have to wonder, why is the first year lower than the second year? And why do we have 6 years for a 5-year asset? The reason we have 5 years is the first year we only get a half a year's depreciation. So it's called half-year convention. So for all of MACRS, and it doesn't matter if I bought that piece of equipment on January 1, June 30th, or December 31st. It doesn't matter when I bought the asset, we'll get half a year's depreciation, even if we only owned it 1 day. Or we only get half a year if we owned it for 12 months, which doesn't seem real fair, does it? But that's just the tax law. It just makes it black and white. You don't get half a year whenever you bought it. So $9,000, and that's why we're going to go into 6 years, because we have half a year the first year, and then 1, 2, 3, 4, and then another half year for year 6 to total the 100%. So let's go put these in our Excel and our depreciation schedule. So we would have our 9,000 that we saw for previously, 14,4, and then you can go to the table and figure out the rest of those. So again, I didn't have you bother with the monthly, but you can finish that on out. The 3-year, just use those rates and take it times $45,000. Okay, so that is really going over the idea of depreciation. We have gone over how you're going to set up your Excel spreadsheets, and also, and just as importantly, what does it matter? Why is it such a big deal whether we use a straight line rate versus an accelerated rate?